Let's just start with the mood music, if you like. It's been an interesting year, I think it's fair to say, for leveraged finance. So give us what the feeling is on the ground at the conference.
Well, thank you for having me, Ed. And it's this is our 26th annual conference, our first and hopefully last in virtual. Obviously, we're all hoping for March 22 to be back in person, but it's been a good opportunity the past few days to take stock on what's happening in the credit markets. We've had 300 companies here, nearly 4,000 individuals participating, so real ecosystem of the leveraged finance markets. And when you look at what we've heard over the past few days, it's been about here increasing confidence about the economic recovery with the vaccine rollout, continuing monetary policy support, obviously an increase in fiscal stimulus on the way. All of that has the confidence of the investor base and the corporate leaders in being how where we're going and what's on the horizon.
Let's just talk about that stimulus, Kevin, for a moment. Look, obviously, a lot of the exuberance we're seeing in all markets right now is being driven by the Fed and expectations that there will continue to be flow of money into the markets. Is there a way in leveraged finance of the Fed sort of stepping back and unwinding some of what's going into the market without bursting the bubble?
Well, I think, they will have to do that over time. But when you look at the impact that it's already been put in place, and the amount of cash that we are seeing in the system, I'm going to give you some context around it, where in 2013, our prior all-time low in the high-yield index, we hit about 5.25%. We are now, we've taken out put in a new low at 4.73% earlier this year. We're only 11 basis points off that. So the impact has been put into the market. It is going to take time to unwind this. Certainly what we're hearing from them is not the case. Yes, can it be done orderly? But time will tell.
Talk to me about where that money goes, because, look, obviously through the crisis, there was a tremendous refinancing need for a whole welter of companies. There continues to be this enormous demand. But I'm interested where it finds a home, because presumably the refinancing is mostly done now. So is this just going to be for M&A or other corporate activities?
So you're right. During 2020, it was very much about stockpiling liquidity, weather the storm. As we got later into 2020, it started to shift towards more opportunistic refinancing, and that's what we saw as rates continued to grind tighter. That's definitely been the case in the start of 2021. About 2/3 of the activity we've been seeing this year has been refinancing driven and companies opportunistically lowering their cost of capital. We are starting to see more activity in M&A. The visible pipeline from a financing standpoint in M&A is about $65 billion globally. We do expect that to continue to grow as the confidence builds. That liquidity that we're seeing in the markets is also on the balance sheets of the corporations, and obviously with the private equity players as well looking to invest. We do expect it's going to pick up in M&A, and we'll see more of a shift, which will have a better shot at satiating some of this demand.
As well as a lot of companies that are at your conference, you also have a lot of investors as well, many of whom have got into the private lending space and doing some form of, financing directly. I wonder how much of a competitive threat that presents today, and particularly through a crisis like this where you have seen such a run-up in demand, how potentially that's changed the dynamics between traditional lending banks like yourself and the shadow banking industry.
Well, I think when you look at us versus the direct lender base, first of all, what we are running for any of our clients is an auction. And an auction is best served by getting max number of participants to drive the lowest cost of capital. So we look at the model that we bring to the market. It can ultimately drive the lowest cost of capital for our issuers. It also taps into the deepest pool of capital in the world. We're able to bring issuers globally. Every deal we launch, we're launching that globally across Asia, Europe, and the U.S. So again, maximizing the number of participants, but also opening up different pools of capital from a currency standpoint. And then there's a lot of other things that we provide as a bank that are core to a company's operations and its financing needs that a direct lender cannot do. So yes, there are segments of our opportunity universe that will go to direct lenders, but we still look at what we have as a superior model.
Kevin, just before I let you go, in a word, you've been in this market a long time, very experienced. Have you been surprised by just how robust the leveraged finance market has been through this crisis?
Yeah, I think there has been a little bit of surprise, but I think when you look at what the Fed did and the ECB did, the stimulus behind that, it certainly motivated and pushed cash into the markets. So when you look at the programs that went behind it, and you look at the opportunity to deploy that capital, these are some of your deepest markets and a good opportunity to drive yield in a yield-starved universe.